Welcome back to the deep dive. Today we are walking straight into what might be the most uncomfortable but absolutely essential conversation in investing.
It really is.
Everyone spends countless hours researching what to buy, right? Where to find the value, how to build a position, but almost no one talks about the other side. The moment that actually, secures the wealth, the exit.
It's the great paradox of investing, isn't it? The whole pursuit is about buying, but the actual capture of wealth is all about selling. And this deep dive, it's about the single hardest discipline an investor has to master.
Why is it so hard?
Because it's the moment you have to act completely against the current.
Yeah.
Against euphoria, against greed, against every bit of confirmation bias screaming in your ear that you're a genius.
So we've pulled together the source material on the ultimate exit strategy, and we're using the silver market cycle as, well, our perfect case study. It's just a brutal, repeating lesson in what happens when discipline fails.
It is. And our mission today is to give you a framework, both psychological and tactical, to make sure you don't just ride the elevator all the way up to the penthouse.
Only to ride it right back down to the lobby.
Exactly. And that framework has to be defined now, today, while you are rational. Because I promise you, the peak of the market, you won't be.
And we have to start with, I think, the most fundamental truth of these commodity super cycles. They don't just level off and stay high.
No, they never do.
They always, always crash. And look, this isn't pessimism. This is just historical fact.
It's a stark warning etched in every market chart. I mean, just look back to 1980. This wasn't some gentle rise. This was the Hunt brothers trying to corner the physical market. It was pure mania.
Silver went parabolic.
Absolutely parabolic. It rocketed up to $50 an ounce. And people who just gotten in felt like the smartest people in the world. The story was, the dollars finish, silver is the only real money.
But that narrative slammed into a wall of reality.
And the crash wasn't slow, it was violent. Once the exchanges changed the margin rules, you had Silver Thursday. The price just collapsed. Within a couple of years, it was back down around $5.
$5, so that's a 90% loss.
A 90% loss for anyone who held on, paralyzed by greed and the belief that 50 was just the beginning. They went from being paper millionaires back to, well, not being millionaires, all because they failed to sell into that incredible strength.
And if 1980 feels like ancient history to you, let's just fast forward to 2011.
The exact same story.
It's the same playbook. Silver picks right around $49 an ounce. The narrative is identical. Quantitative easing is debasing the dollar, global instability.
And the prophets were out there guaranteeing, $100, $200. I even heard $500 silver.
So people waited. They held on for those big round numbers. And what happened?
The same thing. The speculative froth just vanished. The price crashed all the way down to $13. So again, you're looking at a nearly 75% loss for anyone who listened to the moon crowd instead of a disciplined plan.
The sources call this a round trip to wealth and back to poverty. And that phrase, it's just terrifying. It means you had it, you saw it on your statement, and you just gave it all back to the market.
Purely out of greed. And that failure of execution, that's what this whole deep dive is designed to prevent. And it brings us to, I think, the most important rule in all of this. It's the old market adage you have to tattoo on your brain.
Bulls make money, bears make money.
Pigs get slaughtered.
And that says it all, the greed factor. It's not enough to be right on the buy. You have to be disciplined on the sell. And that means deliberately choosing to walk away with a massive profit instead of chasing that last impossible-to-catch dollar at the absolute top.
You have to accept you will leave some money on the table. And that acceptance is the price of not losing everything.
Okay, let's really unpack the emotional landscape here, because if you don't understand the psychological warfare you're about to face, you've already lost.
That's right. The battle is internal first.
You said tops don't form when people are scared. They form in an atmosphere of euphoria.
Total euphoria. Universal certainty. Think about the cognitive biases just running rampant. You've got confirmation bias. You've got recency bias.
What do you mean by that?
Well, every single morning you wake up, your silver position is worth more than it was the day before. Your contrarian decision to buy, which maybe your friends and family laughed at, is being proven right. Daily.
So you start to feel invincible, like a genius.
Exactly. You feel like you've seen a truth that no one else could. And in that environment, the act of selling feels like, well, it feels like pure foolishness. It feels like self-sabotage.
Why would I sell today for $120 an ounce when everything, my own experience, the news, the forums, everything is telling me 200 is right around the corner?
And that is the absolute core of the problem. That's the contradiction. The day you absolutely must sell to preserve your wealth is the exact same day you will desperately want to buy more. You want to mortgage the house to buy more.
That's the test.
That is the ultimate test of discipline. You're not fighting a loss, you're fighting overwhelming, profitable, intoxicating success.
So you can't trust your gut. You need external signals, hard tactical triggers that cut through that emotional fog.
You need them. You need anecdotal evidence that the mania has reached psychological saturation.
Yeah.
That has broken out of the financial world and into the real world.
And the sources have some great examples of this. The classic one.
It's the classic for a reason. Your primary signal to start selling is when your neighbor, the one who for 10 years told you were crazy for stacking metal, when he corners you at the mailbox and starts asking you with this desperate look in his eyes how he can buy some right now.
But hold on. Let me challenge that a little. Couldn't that just be a sign of broader adoption? I mean, if the fundamentals are really changing, you'd expect new people to come into the market, right?
That's a fantastic point, and it's a crucial distinction. You have to ask, why are they coming in? Is your neighbor suddenly an expert on fiat currency debasement and industrial supply deficits?
Probably not.
No. He's buying because he saw it on the news, and he's got a bad case of FOMO fear of missing out. He's chasing price, not fundamentals. When the last skeptic finally capitulates to pure greed, that's when you know the retail herd is all in.
And for the smart money, the herd is their exit liquidity.
The herd is the bag holder. The media just pours gasoline on this fire.
So you're saying when the asset crosses over from being a niche topic on financial blogs to being the lead story on the evening news?
That's your cue. And you have to listen to the tone of the coverage. When CNBC and Bloomberg stop having a balanced debate and start running these breathless, hour-long specials.
The silver supercycle.
Yes. Why $500 silver is inevitable. When the analysts who were bears for a decade suddenly flip and become mega bulls, you know the rocket ship is running out of fuel.
So the smart money, they're not waiting for the price to drop. They're not reacting. They're proactively selling into this wave of new buyers.
That is the entire strategy of the contrarian exit. They need volume. They need thousands of buyers to absorb their massive positions. They can't just dump it all at once. So they feed it out piece by piece to the latecomers who are euphoric. They are selling into strength.
And the danger of waiting. This is something I think people don't get. It's about the mechanics of the crash.
It's the liquidity cliff. It's a terrifying concept. If you wait until you see the price start to visibly drop, even by a few percent, it's too late.
Why?
Because liquidity just evaporates. It's gone. The speculative buyers who are only there for the ride up, they vanish overnight. Think of it like a deep pool. At the top, you can move around easily. Once the price breaks, the water drains out instantly and you're stuck in the mud.
So you might see a price on the screen, but you can't actually sell at that price.
You can't. You can try to sell 1,000 ounces and you'll find there are no bids. The market just disappears. You're forced to chase the price down, offering bigger and bigger discounts just to find a buyer.
So discipline isn't just a virtue. It's a logistical necessity.
It dictates selling on the way up, methodically, while the party is still raging. That's how you get out clean. That's the difference between a trader and a pig.
Okay, we've anchored the psychology. Now let's get tactical. We need specific, measurable external signs that you can write down today in your plan.
Exactly. Things that are not based on your feelings, but on observable market data and real-world events.
We're looking for signs that confirm two things, right? One, the market is saturated with speculative greed. And two, the fundamental industrial side of the equation is starting to break.
You need confirmation on both axes. Because a top built only on retail hype can be fragile. But when the industrial demand itself starts to crack, that's when the whole foundation of the market is in danger.
Let's start with the clearest one, the one you can see and feel. Full-blown retail mania. And we're not talking about what we see today with, steady online sales. We're talking about a system-breaking level of demand. What does that actually look like on the ground?
It looks like a breakdown of the physical supply chain. It's unmistakable. At a real top, you will see actual lines of people wrapping around the block at local coin shops.
People waiting in the rain.
Desperate to get their hands on physical metal. The small dealers will have signs up sold out of silver because they just can't get resupplied fast enough from the mints and wholesalers.
Or what about online?
The online infrastructure just buckles. The big bullion dealer websites, your APXs, your JM bullions, they will start crashing because they can't handle the traffic. Orders get delayed for weeks.
Wow. So when the very system designed to sell you the asset breaks down, that's a pretty strong signal.
It's a five-alarm fire. But the most reliable financial indicator tied to all of this, the one you can track with a hard number, is the premium, the explosion of physical premiums.
Explain that. Why is the premium over the spot price so important?
Because when a 1-ounce silver eagle, which has a spot price of, say, $150, starts selling for $200, that extra $50 premium tells you something profound about the buyer.
They're not a rational actor anymore.
They're not. They're in a state of panic. They're willing to pay a massive irrational fee for immediate physical possession. They're not thinking about value. They're thinking about the financial system collapsing tomorrow.
They're paying for insurance on top of an already inflated asset price.
Exactly. And that is the modern version of the shoe shine boy moment, when the last, most emotional, and often most leveraged buyers are flooding in and paying any price just to get in.
The smart money knows it's time to leave the room.
That's when they are quietly handing their metal over to those very people. They know the foundation of the price has shifted from stable demand to pure, unstable speculation.
Okay, so that's the speculative side hitting a fever pitch. Now, let's pivot to the other side of the coin. The cold, hard reality of the industrial market, which is supposed to be the bedrock of demand.
Right. And you might remember we talked about inelastic demand before. Industrial users, the solar companies, the electronics makers, they have to buy silver. It's not optional.
So they'll pay high prices for a long time.
For a long time, yes. They'll just pass the cost on. But inelastic doesn't mean infinite. Every price has a breaking point.
And that's what we call demand destruction. How does that work for silver?
It's triggered by pure economics. If silver hits a certain price ceiling, and the sources suggest this is somewhere between, say, $150 and $200 an ounce, it becomes economically unviable for these companies to use it.
Okay, let's get specific. What happens inside a solar panel gigafactory when silver hits $175?
Well, silver is a key ingredient in the conductive paste on the solar cells. If that input cost quadruples, the final price of the solar panel goes through the roof.
To the point where it's no longer competitive.
Exactly. The utility company or the homeowner building a solar farm looks at the numbers and says, you know what? Natural gas is cheaper now. The demand for the final product dies.
So the solar company stops making panels.
They have to. They halt production lines. They cancel those multi-billion-dollar expansion plans. And crucially, they stop buying silver. The cost has literally killed its own demand.
So what's the headline? What's the external signal we need to be watching for?
You need to watch the business news. The signal is a headline that reads something like, major solar manufacturer halts production, citing soaring silver costs. Or, automakers redesigning electronics to avoid high commodity prices.
When you see that, you know it's not just speculation anymore.
You know the fundamental, physical demand is now officially broken. And that confirms the famous economic principle. High prices cure high prices.
So once the industrial buyer walks away, who's left?
Only the speculators, the fickle money. And without that industrial floor to catch the price, the crash is just. It's immediate and it's violent. The combination of peak retail mania and the start of industrial demand destruction, that is your golden window to exit.
Okay, we've defined the danger, we've identified the signals. So now the solution. How do we actually overcome our own psychology? If trying to pick the absolute top is a fool's errand, what is the actual tool we use?
The tool is a predefined mechanical strategy. It's called Tranche Selling, and its entire purpose is to remove emotion from the equation.
Because the emotional mistake is thinking you can time it perfectly.
You can't. And the attempt to do so leads to paralysis. You either sell too early, watch it go higher, and then FOMO back in at a worse price, or you wait too long and ride it all the way down. Both are disastrous.
I get the idea of not being perfect, but let me push back a bit. If you have high conviction that the price could hit 200, why on earth would you start selling at 100? Aren't you just diluting your own gains?
It's a great question, and it's how most people think. But you're not diluting your gains. You're hedging your execution risk. The goal isn't maximum potential paper profit. It's maximum realized profit.
Okay.
The tranche method is how large institutional funds exit positions. It's a system for ensuring you capture the majority of a huge move without risking that catastrophic round trip.
So let's break it down. The sources say to divide your whole stack into 5 equal parts, 5 tranches of 20%.
That's the model. 5 equal 20% chunks. And the price targets for these are set today, in the calm, not in the storm.
All right. Tranche 1, the first 20%, where does that go?
You sell that at your first rational, significant price target. Let's use the example from the source material and say that's $100 an ounce.
And what's the goal of that first sale?
The goal is almost entirely psychological. It's to lock in a win. With that first sale, you've likely taken all your initial capital back out, plus a nice profit. Everything else you're holding, the other 80%.
Is house money.
It's pure house money. And that fundamentally changes how you view the rest of the position. The fear of losing is gone, which allows you to be much more patient and disciplined for the next targets.
That's brilliant. Okay, so tranche 2.
You sell that at your next higher price target, maybe $125. You're now selling into even greater market euphoria, even deeper liquidity. You lock in an even bigger win.
Then tranche 3 at maybe 150. So at this point, you've sold 60% of your original holdings.
Correct. You've sold the majority of your stack, you've captured the bulk of the big upward move, and you have likely banked what is already life-changing money.
So what about the last 40%, tranche 4?
Tranche 4 is different. Here, you stop using preset price targets. You hold this portion until the price chart itself visibly breaks down. You're waiting for a confirmed trend reversal.
Ah, so you're letting the market tell you the party is over.
Exactly. If it spikes to 250, you ride it. If it then falls hard from that high and breaks key support levels, you sell. This tranche ensures you capture a piece of that final, insane blow-off top, whatever it may be.
Which leaves the final 20%, tranche 5.
That's what some people call the moon bag. This is your permanent worst-case scenario insurance policy. You keep this. This is for the scenario where the dollar actually hyperinflates to zero and physical metal becomes the only thing of value. You don't sell this unless you need it to literally survive.
So this whole method, it just forces you to act with discipline. You capture a high average price without ever having to be a hero and nail the absolute peak.
You might feel a little sting for missing the last 10% of the move, but you will have guaranteed that you captured the first 90%. And avoiding that 75% crash on the other side is worth every penny you left on the table.
Okay, let me throw a wrench in here that people always bring up.
Yeah.
Taxes. You start selling in tranches, you're realizing huge capital gains. Doesn't that just kill your advantage?
That is such a critical real-world question. And it's the excuse many hodlers use to never sell. They see avoiding a tax bill as being financially smart.
But it's not.
No, you have to be able to distinguish between a tax expense and a catastrophic capital loss. A tax on a massive gain is a high-class problem to have. It's a manageable cost of doing business. A 75% crash is a disaster you may never recover from.
You pay the tax and you sleep at night.
You pay the tax, and you now have the dry powder to go and double your stack of ounces. The benefit of locking in that profit far, far outweighs the cost of the tax bill. Don't let the tax tail wag the investment dog.
And that moves us perfectly into this idea of reframing the whole purpose of selling. It's not the end of the game. It's not just cash out and you're done.
No, for the serious long-term investor, it's halftime. This is the cycle trader's secret. It separates the amateurs from the professionals. The real goal isn't to end up with the most dollars.
It's to end up with the most ounces.
The true metric of your wealth is the physical quantity of the hard asset you own. The disciplined investor just uses the fiat system with all its volatility as a temporary vehicle to multiply that asset base.
So the mantra isn't just sell high, it's sell high so you can buy low.
Exactly. The person who just holds forever, the forever stacker, they keep their quantity the same. If you buy 1,000 ounces, ride the cycle up and down, you still have 1,000 ounces. You've preserved your wealth, which is good, but you haven't multiplied it.
Whereas the cycle trader uses that peak mania to fundamentally increase their position for the next run.
Let's run the numbers on that again, just to make it crystal clear. This is the aha moment.
Okay, so I start with 1,000 ounces.
You execute your tranche sales. Let's say your average sale price across those first 3 tranches comes out to $150 an ounce.
Okay, so 1,000 ounces times $150. I'm sitting on $150,000 in cash.
Realize cash. It's in your account. You've locked it in. Then you wait. The inevitable crash happens, the market resets over a few years, and silver finds a new, higher floor. Let's call it $75 an ounce.
So it got cut in half, but it's still way higher than where I originally bought it.
Exactly. Now you take your $150,000 that you patiently protected, and you go back into the market.
$150,000 divided by $75 an ounce.
It's 2,000 ounces.
Yeah.
You just doubled your stack. You went from 1,000 ounces to 2,000 ounces in one cycle. Meanwhile, the hodler who refused to sell, he still has his 1,000 ounces. He feels vindicated that he didn't lose anything, but he missed the opportunity of a decade.
Your discipline literally doubled your foundational wealth.
This is what should motivate you. This is the true purpose of selling. When you refuse to sell the top, you are actively choosing not to compound your core asset. You are letting greed starve you from doubling your long-term wealth.
It totally flips the script. Selling isn't an act of betrayal to the asset. It's the ultimate act of faith in its long-term value because you're working to acquire more of it. Okay, this brings us to the next critical and I think often totally overlooked step in the plan, the protection phase. You've done it, you sold, you're sitting on a big pile of cash. What now? This is a high-risk moment in its own right.
It's incredibly high risk because you are now holding the very thing you were trying to protect yourself from in the first place. Melting fiat currency. The inflation that drove silver up is still out there, eating away at the purchasing power of your cash. You can't just let it sit in a checking account.
The clock is ticking. So the goal here is twofold, right? Preserve the capital and keep it liquid enough to redeploy when the time is right.
Preserve and be ready.
Yeah.
That's it. So you need a parking lot for your capital, a safe place to wait out the storm.
And the sources give us two main options here. Let's start with the most conservative, the safest play.
Option A is short-term U.S. Treasuries, T-bills. We're talking about very short duration instruments, 4-week, 13-week bills. In the current environment, they might be paying you, say, 5%.
Which might not even beat inflation, but that's not the main goal.
The yield is not the primary goal. The goal is zero counterparty risk. They are backed by the full faith and credit of the U.S. government and extreme liquidity. You're preserving your capital in the safest place on earth.
And why short-term specifically? If you think the wait might be 3 or 4 years, why not lock in a higher yield on a longer-term bond?
Because your number one priority is optionality. You need to be able to access that cash instantly with no penalty the moment silver hits your buyback target.
When the blood is in the streets.
Exactly. Longer-term bonds have interest rate risk, and you might take a loss if you have to sell them early. Short-term T-bills are constantly maturing, giving you immediate access to your cash. You're keeping your powder dry and safe.
Okay, that makes total tactical sense. What's the other option, the more active strategy?
Option B is rotating into undervalued, cyclically hated assets. The whole idea of a cycle is that when one asset class is in a euphoric mania, another one is usually in the dumps. Hated, cheap.
So you're taking your profits from the overvalued asset.
And you're moving them directly into the undervalued one. You're constantly rotating your capital away from euphoria and towards depression.
How do you identify a hated asset in that kind of environment? What are you looking for?
You look for the things that everyone is panicking out of. Maybe the broader stock market has crashed because of high interest rates. Maybe the real estate market is on its back. Maybe the energy sector is being treated like a pariah. You look for historically low valuations, low price-to-earnings ratios.
So you're looking for the mirror image of the silver market's euphoria.
Precisely. You sell your silver at 150, take that cash, and maybe you buy into a dividend-paying energy stock that's trading at a 5-year low. You let that asset appreciate while you wait for silver to correct.
And then when silver hits your $75 target, you sell the energy stock, which is hopefully recovered, and you use those proceeds to buy back your 2,000 ounces of silver.
Now you've compounded your wealth twice. The key instruction, no matter which option you choose, is keep the money moving. Do not let it sit idle. Treat the cash as a temporary bridge to get from one hard asset back to an even bigger position in that same hard asset.
Okay, let's bring this all together. Let's synthesize this into the smart money playbook. Buying is fun, it's easy. Selling is work. It's the hard, disciplined effort required to actually win the game.
So this is the final summary for everyone listening. The 4 non-negotiable steps of discipline that you have to commit to.
Step 1, and it's the most important. Write the plan now. All of this, your tranche targets, your signals for retail mania, your cash parking strategy, it has to be decided today. Written down. On paper.
Because the version of you at the market peak, the one who's flush with cash and feeling like a genius, cannot be trusted to make a rational decision. That person is your worst enemy. Step 2, ignore the noise. When your plan tells you it's time to sell, you execute. You ignore your friends telling you you're crazy. You ignore the headlines screaming about $1,000 silver. You remember 1980. You remember 2011. You trust your plan, not the narrative.
That's the hard lesson. Pigs get slaughtered. Take the win.
Step 3, scale out. Use the tranche strategy. Don't try to be a hero and sell it all at once at the perfect top. It's impossible. Sell in pieces. De-risk your position systematically. Capture the momentum on the way up. It's your psychological defense mechanism against regret.
And then after the selling is done, comes what might be the hardest part of all.
Step 4, be patient. The waiting. After you've sold and parked your cash, you have to wait. You can't get lured back in by a small bounce. You have to wait for the market to fully reset, for the speculators to be washed out, for the blood to be in the streets. That's when you re-enter.
The analogy that really sticks with me is leaving the party while the music is still playing.
That's it. The party is fun, it's euphoric, but you know the hangover is coming. And the crash in these markets isn't a headache. It's a brutal, decade-long migraine.
So you have to be the one who has the discipline to just quietly walk out with your winnings before the chaos breaks out.
And that takes incredible confidence in your plan. It requires a total rejection of the herd mentality. You have to accept that you're going to feel a little bit of pain for leaving early, but that little bit of pain is the price you pay for securing your wealth.
So after all of this, what it really boils down to for you, for the listener, is an unavoidable choice. You're going to face an emotional trade-off at the peak, and you have to choose between two very different kinds of pain. The choice is between seller's remorse and bagholder's regret.
And they are profoundly different. One is a productive, manageable pain. The other is a destructive, catastrophic one.
So let's define them. Let's be crystal clear. What is seller's remorse in this context?
Seller's remorse is the mild, controlled sting of a successful plan. It's selling your third tranche at $150 an ounce and then watching the price briefly spike to $175 before the crash begins.
You missed the absolute top.
You missed it. You left some money on the table, but you also walked away with enormous, realized, spendable wealth. It's a calculated loss of some potential paper profit. It is the signature of a successful exit.
You left the risk behind with the money.
Exactly. Now, compare that to bagholder's regret. This is the catastrophic, soul-crushing pain of watching your portfolio go from a peak of $150 an ounce all the way back down to $75.
Losing half of your paper wealth or more.
Losing all of your gains. It's the direct result of a failure of discipline. It's the pig getting slaughtered. And that pain doesn't go away in a week. It can last for a decade while you wait, just hoping to get back to break even.
The distinction is everything, isn't it? Which pain do you choose? The mild ache of capturing 90% of the move, or the life-altering agony of losing it all because you greedily chased the last 10%?
The smart investor chooses remorse every single time. Remorse is the byproduct of a good plan. Regret is the consequence of no plan.
So we leave you with this challenge. Choose your identity now, today, while you are rational. Are you preparing to be a cycle trader? Someone who uses this volatility to methodically compound your ounces and build real generational wealth?
Or are you content to be a forever stacker? Someone whose lack of a selling discipline puts them at risk of that full, painful round trip from wealth back to poverty.
The foundation is set. The plan is clear. Now is the time to write it down.
Because the future of your wealth depends not on your ability to buy, but on your discipline to sell.
Until the next deep dive, thank you for joining us.